Hey everyone. Feeling a little overwhelmed by all the financial news out there lately? Yeah, I get it. It's like drinking from a fire hose sometimes, right? But don't worry, you're in the right place. Today we're going to cut through all the noise and take a deep dive into the world of financial bubbles. We're going to try to understand what causes them, how to spot them, and most importantly, how to protect ourselves. Our guide for this deep dive is finance educator Nolan Mathias, and specifically his YouTube video titled, "This is what always happens before a financial bubble bursts." Okay, always, huh? That's a pretty bold claim. But hey, let's see what he has to say. So we're not just going to learn how to spot a bubble, we're going to try to understand the psychology behind them, the historical context, and of course those actionable insights that can help us make smarter decisions. Think of it like bubble busting boot camp, but way more fun.
Right. And what's fascinating is that whether we're talking about tulip mania in the 1600s or the dot-com crash in the 90s, there are these undeniable patterns that keep repeating throughout history. Matthias kicks off his video with some pretty mind-blowing examples. Like, imagine a single tulip bulb selling for the price of a mansion, or a company's value skyrocketing just because they added .com to their name. It sounds crazy, right?
Totally. It's like people lose all sense of reason. But that's the thing about bubbles. They thrive on emotion. Matthias makes the point that all these historical events, as different as they seem, they all share a common thread, this powerful combination of economic cycles and our unchanging human psychology.
Exactly. It's like history is playing out on a loop just with different costumes and props each time. And one of the most common refrains you hear during these periods of speculative frenzy is that this time is different.
Oh yeah, I've heard that one before too many times. It's almost comical how predictable that sentiment becomes in hindsight. You'd think we'd learn right.
You would think, but that belief in a new paradigm is a key driver of bubble formation.
So, okay, let's break down the anatomy of a bubble. Matthias outlines 5 distinct stages that each have their own unique psychology. Can you walk us through those?
Sure. The first stage is what Matthias calls displacement. This is where a new innovation or paradigm shift sparks excitement and captures the imagination. Think of Bitcoin and the idea of decentralized currency. It was disruptive, it was new, and it seemed to have the potential to change everything.
It's like dropping a match in a dry forest.
Right.
Suddenly, the whole market explodes with interest.
Exactly. And then we move into the boom stage, where prices start to climb, attracting more attention and fueling optimism. Think of the early 2000s housing market. Initially, it seemed like a healthy market, but those rising prices were actually the seeds of a bubble being sown.
Right. And as more and more people jump on board, that little spark turns into a raging wildfire. So, what happens next?
Things get really interesting and potentially dangerous when we enter the euphoria stage. This is where momentum builds, FOMO kicks in, fear of missing out, and the greater fool theory takes hold. Suddenly, everyone's an expert. Matthias uses this really vivid example of taxi drivers owning multiple houses. People are buying not because they believe in the underlying value, but because they think they can sell it to someone else for even more later on.
It's like a game of musical chairs. But in this version, people keep piling more and more chairs onto the shrinking space. But eventually the music has to stop, right?
Unfortunately, yes. And when it does, those left standing without a chair are in for a rude awakening. But before the music stops, the savvy investors, the so-called smart money, start to recognize the warning signs and they quietly exit. This is what Matthias calls the profit-taking stage. They lock in their gains and reduce their risk while everyone else is still caught up in the euphoria.
It's like they have a sixth sense for when the party's about to end. But for everyone else, what happens?
Well, that brings us to the final stage, panic. The bubble bursts, mass selling leads to a price collapse, and those who bought in late are often left holding the bag. Think of the dot-com crash or the 2008 financial crisis. People lost their life savings. It wasn't pretty.
It's a stark reminder that what goes up must come down, especially when it comes to assets driven by speculation rather than fundamental value. So knowing these stages seems pretty crucial. But how does it actually help us make better decisions?
Recognizing these stages isn't about timing the market perfectly. That's nearly impossible. It's more about understanding the potential for a bubble to burst and making more informed decisions accordingly. It's about having a plan and knowing when to step back from the dance floor before the music stops.
So we've got those 5 stages down.
Yeah.
But what about those red flags? Are there any specific signs that scream, hey, this might be a bubble?
Absolutely. And Matthias highlights several key ones in his video.
Let's hear them.
Well, one of the biggest red flags is what Alan Greenspan famously called irrational exuberance. It's that feeling when the excitement surrounding an asset class just seems completely detached from reality.
Like when people were mortgaging their homes to buy Dogecoin, that definitely gives off some serious, this time is different vibes.
Exactly. And speaking of Dogecoin, another warning sign is what Matthias calls the everyone's getting rich effect. When you start hearing stories about everyday people making these risky bets and scoring big, that's often a signal that speculation has gone way too far.
Yeah, it's like the classic taxi driver stock tip scenario, but amplified by social media. Suddenly, everyone's a financial guru,
Hmm.
and that FOMO, that fear of missing out, takes over.
Right. And another red flag Matthias points to is the emergence of what he calls dangerous financial innovation. Think of those complex instruments like collateralized debt obligations or CDOs that fueled the 2008 housing crisis.
Oh yeah, those CDOs, they were basically just bundles of mortgages, right? But they were so complicated that even the experts didn't really understand the risks involved.
Exactly. These types of innovations often make speculation easier and they can mask those underlying risks, which makes them particularly dangerous during a bubble.
It's like giving someone a turbocharged engine without teaching them how to drive.
That's a great analogy. And then there's the shift in media coverage. Matthias uses the example of cryptocurrency, where you saw this gradual shift from initial skepticism from the media to unbridled enthusiasm.
Oh yeah, I remember those days. Headlines were screaming about Bitcoin going to the moon, and everyone was convinced they were going to miss out on the next big thing.
Right. That kind of media hype can really fuel a bubble. And finally, there's what Matthias calls the mathematics of impossibility. This is when valuations just completely defy all logic.
Like when Dogecoin's market cap for a brief shining moment exceeded that of established Fortune 500 companies. That's when you know things have officially gone bonkers.
It really does. It's like the financial world is operating in an alternate reality. I think if we connect these red flags to the bigger picture, it becomes clear that critical thinking is absolutely essential, even or perhaps especially when everyone around you seems to have lost their minds.
Yeah, it's so easy to get swept up in all the excitement. But taking a step back, looking at the situation objectively, asking those tough questions, that can save you a lot of heartache in the long run. Okay, so we've learned how to spot a bubble. We've learned how to recognize those red flags. But how do we actually protect ourselves? What actionable advice does Matthias offer?
Well, Matthias emphasizes a few key strategies that I think are worth highlighting. First, and this is a classic, be cautious when optimism is high. If everyone seems certain about an investment, it might be a good time to step back and reassess the situation.
It's like that old saying, be fearful when others are greedy.
Exactly. Second, assess for overvaluation. Look for those disconnects between price and fundamentals. Remember when Tesla's valuation just soared even though their revenues were significantly lower than other major automakers?
Oh yeah, that was a head scratcher for sure. So basically, don't just buy into the hype. Do your research, look beyond the headlines, and make sure the numbers actually make sense.
I couldn't have said it better myself. And third, diversify. 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 Spread your investments across different asset classes to mitigate risk.
That's where a well-balanced portfolio comes into play, right? Having that mix of stocks, bonds, real estate, and other assets can really help to smooth out those inevitable market bumps.
Absolutely. And don't forget about good old-fashioned bonds. They may not be as exciting as the latest meme stock, but they can provide much-needed stability during those turbulent times.
It's all about balance, right? Having that solid foundation can make all the difference.
Exactly. And here's another crucial piece of advice. Avoid using debt for risky assets. Don't gamble with borrowed money, especially when FOMO is clouding your judgment.
Yeah, that's a recipe for disaster. It's
Yeah.
like pouring gasoline on a fire.
And finally, focus on long-term stability. Prioritize consistent growth over chasing those quick riches. Remember, slow and steady often wins the race.
It's like building a house on solid ground, right? You don't want to build your financial future on a foundation of sand.
That's a great way to put it. Building a strong financial future isn't about getting caught up in those speculative frenzies. It's about making smart, informed decisions that align with your long-term goals.
We've covered a lot of ground today. We've explored the anatomy of a bubble, learned to spot those flashing red flags, and even picked up some actionable strategies to protect ourselves. But before we wrap up, is there one big takeaway you'd like to leave our listeners with?
I think Matthias's mentor actually summed it up perfectly. He said, be fearful when others are greedy, and greedy when others are fearful. It's such a powerful reminder to think independently, question those assumptions, and resist the urge to follow the herd.
It's such great advice.
Mm.
It's so easy to get caught up in the excitement of a bull market and forget that what goes up must come down.
You're absolutely right. And when that downturn inevitably happens, it's those who stayed level-headed, those who stuck to their long-term plan, who are best positioned to not only weather the storm, but also to potentially capitalize on those opportunities that emerge.
So it's not just about avoiding those losses, it's also about being ready to seize those moments when everyone else is panicking. I like that.
Exactly.
Well, we've covered a lot of ground today. We explored the anatomy of a bubble, learned to spot those flashing red flags, and even picked up some pretty actionable strategies to protect ourselves.
We did. And I think what's so important to remember is that understanding these patterns, it's not about becoming a doomsayer or predicting the exact timing of the next crash.
Right. It's about being aware of the cyclical nature of markets and being prepared for those inevitable ups and downs. It's about having a plan and knowing how to adjust that plan as the market environment changes. So as you navigate these sometimes turbulent waters of the financial world, remember to stay informed, stay vigilant, and most importantly, stay true to your own investment philosophy. Don't let the fear of missing out or the allure of quick riches cloud your judgment.
Excellent advice.
And hey, if this deep dive sparked any aha moments for you, or if you have any burning questions, we'd love to hear from you. You know where to find us on social media. Let's keep this conversation going.
Until next time, happy investing.